Hi, hello, good day everyone. I'm Korsha Miranas and together with me is Miss Lady Nicole Baldoza and Mr. Adonis Vistal. So we're going to tackle about the chapters 14 entitled Corporate Restructuring, including takeovers and divestment. So, introduction. A striking feature of the post-war business scene throughout the world, but particularly in the UK, is the extent of the use of various corporate restructuring devices. This feature has become more evident over time, perhaps promoted by the emergence of increasingly sophisticated techniques for achieving corporate restructures. Changes in the economic environment and in the objectives being pursued by the particular business may be seen by that business as necessitating significant changes in its structure. Such changes may be concerned with the assets employed or with the manner in which those assets are financed or with some combination of the both of these. Whatever the precise nature of a particular corporate restructuring, logically it should be pursued to work towards and achievement of the business objectives. So, corporate restructuring is clearly a necessary and desirable feature of any dynamic and flexible economic environment. Despite the bad publicity that has attached to some aspect of certain corporate restructuring is, in a sense, a means for businesses to pursue their legitimate objectives. So, takeovers and mergers. In recent years, buying existing businesses in their entirety has become a very popular way of investing and growing. For example, the food or the notably sugar business Tate and Lyle says in its 2007 annual report, we continually evaluate acquisition opportunities that would add strategic value by enabling us to enter new markets or add products, technologies, and knowledge more efficiently than we could originally. Not all businesses seek to expand in this way, nor do those that have done so necessarily do it habitually. In practice, this type of investment is typically affected by one business or the bidder buying sufficient ordinary voting shares in the other one, or the target, to be able to exercise control or even to have complete ownership. Whether a particular situation is described as a takeover or as a merger is a matter of semantics. Where the two businesses are of similar size and there is agreement between the two sets of management as to the desirability of the outcome, then it tends to be referred to as a merger. Otherwise, the expression takeover tends to be used. Despite certain apparent differences from the bidder's investors' viewpoint between a merger and a more traditional investment opportunity, the same basic principle should be applied to its appraisal. This is to say, a merger that would represent a net increase in the current worth of the bidder or a positive net present value should be pursued if its financial objective is to be achieved. Increasingly, particularly since the turn of the millennium, private equity funds have been bidders and have undertaken takeovers or other businesses. In fact, many such funds were established to take over other businesses, restructure them, and then sell them on, in some cases by relaunching them as listed businesses. Reasons of mergers. In theory, a business will become a bidder when it sees an opportunity to make an investment with a positive incremental net present value. It is likely to pursue such an opportunity either where it considers that the incremental cash flows from the investment, when discounted at a rate consistent with the level of fees associated with those cash flows, are positive. And second, where the reduction in the level of fees associated with the bidder's existing cash flows causes the appropriate rate for discounting those cash flows to fall, thus increasing the NPV of the existing cash flows of the bidder.
Bidder plc is expected to generate net positive cash flows of €1 million PA forever. The level of risk associated with these cash flows is perceived by the capital market as justifying a rate of return of 15% PA. Thus, the net present value of bidder is 1.5 million, 0.15 equals 6.67 million. Bidder sees an opportunity to acquire the entire equity of Target plc. Forecasts indicate that the annual net positive cash flows of the merged business would be 1.5 million euro forever, and that the required rate of return would be 12% PA. The net present value of Bidder after the merger, should it takes place, would become 1.5 million euro times 0.12 equals 12.5 million. This would imply that it would be worth Bidder paying any amount up to 5.83 million euro for Target. Note that the part of this amount arises from the existing cash flows of Bidder being discounted at a lower rate than previously. This factor could arise only where the merger had the effects of reducing risk. It is quite feasible that 5.83 million exceeds the current market value of Target. The reason why this could be the case included is because Target's expected cash flows being less than 0.5 million euro PA, that is, the merged business might be able to generate more expected cash flows than the sum of the expected cash flows of the separate businesses. And the possibility of the risk attaching to the combined business being less than applies to the overall level of the separate parts. Elimination or reduction of competition. Where the Bidder and Target are in competition for the market for their unit, a merger could lead to a monopoly or at least a larger market share for the merged unit. This strength in the marketplace might enable prices to be raised without loss of turnover, hence an increase in cash flows. As we shall see later in this chapter, in the UK such a merger may well fall foul of the Competition Commission. So this refers to the potential consequences of a merger of acquisition between two companies that are competitors in the market. When the Bidder, the company attempting to acquire another company called the Target, and the Target are competing in the same market, the merger can result in the elimination or reduction of the competition. So if the merger is successful, the combined company may achieve a dominant position in the market, potentially leading to a monopoly or a significantly larger market share. This increased market power can give the merged company the ability to raise prices without losing customers, resulting in higher cash flows or profits. Next is safeguarding sources of supply or sales outlets. A Bidder may be attracted to a merger where the target is a supplier or of some vital raw material which is in short supply or which the target could stop supplying beyond the control of the Bidder. Similarly, where the target represents a major sales outlet for the Bidder, the target could cause problems for the Bidder if it started to promote sales of the product of one of the Bidder's competitors. Here, our merger may not increase an annual cash flows, but it may well lower the perceived risk because the cash flows of both parts of the combined business would become more certain. So it means that a company may be interested in acquiring another company because the target company either supplies a vital raw material that is scarce or has the ability to disrupt the supply, or it serves as a significant sales outlet for the acquiring company's products. If the target company is a supplier of a critical raw material that is in short supply, the acquiring company may be concerned about the possibility of losing access to that raw material if the target company decides to stop supplying it. By merging with or acquiring the target company, the acquiring company can ensure a stable and consistent supply of the raw material, reducing the risk of the disruption in its operations. Next is access to the economies of scale that a larger business could yield. Economies of scale may be envisaged in a wide variety of areas. Such economies might include greater buying power, leading to the lower prices being paid for supplies of goods and services. So, a larger business can negotiate better deals and obtain lower prices when purchasing supplies of goods and services. Suppliers may offer volume discounts or preferential pricing to larger customers, allowing the acquiring company to reduce its cost and improve profit margins. Larger production runs leading to savings in setup cost and other overheads. So larger production runs. So with a larger scale of operations, the merged or acquired company can increase production runs, leading to savings in the setup cost and other overhead expenses. Next, combining administration and accounting activities, leading to savings in the associated cost and combined administration and accounting activities. By merging with or acquiring another company, there is an opportunity to consolidate administrative and accounting functions. Next, raising and servicing finance, being on a larger scale and therefore possibly cheaper. So economies in finance operating on a larger scale can provide advantages in raising and servicing finances. These economies of scale would tend to give rise to decreased total cash outflows. Next, we have here access to some aspects of the target that the buyer considers underutilized. Assets considered to be underutilized might include particular tangible assets, including land, plant, and cash, that are not fully exploited, and particular intangible assets such as standing in some market, perhaps an export market or a particular contract, or technological expertise, which could be better exploited. Underutilization of assets suggests poor management, and buyers will sometimes be attracted to such targets where they have an abundance of management skills themselves. Businesses must seek ways of promoting rising management talent and expansion through merger with mismanaged business provides an excellent means of creating opportunities for promotion, and their utilization of assets implies the possibility of acquiring assets at a discount on their potential economic value. The overall effect of such mergers would be expected to be an increase in positive cash flows through stronger management skills being brought to bear on the target's assets. They may also decrease uncertainty about the cash flows. In other words, they may reduce risk. So, by acquiring a company with underutilized assets or capabilities, the buyer believes it can unlock additional value and realize greater returns on investments. It may have the necessary resources, expertise, or market access to fully exploit the untapped potential within the target company, leading to increased revenues, improved profitability, and enhanced market positions. Next, we have here risk spreading and reduction through diversification. Merging two businesses with different activities will reduce risk since the returns from the different activities are unlikely to be perfectly positively correlated with one another. Although this factor is frequently put forward as the justification for such mergers in the context of maximization of shareholders' wealth, it could well be invalid. This is because, as we saw in Chapter 7, such diversification could be and probably is undertaken by individual shareholders at a little or no cost. Having this done for them may not increase their wealth. The evidence on the success of mergers in practice we shall review later in the chapter seems to indicate that diversifying mergers are not successful. So this refers to the potential benefit or merging two businesses with different activities in order to reduce overall risk. The idea is that by combining businesses that have activities with different risk profiles, the returns from the activities are unlikely to be perfectly positively correlated. As a result, the merged entity can achieve a more balanced and diversified portfolio, reducing the overall risk level. Synergy. We can see then that in theory, mergers can bring real benefits to shareholders owing to genuine increases in positive cash flows and or risk reduction. These benefits are often referred to as arising from synergy, a 2 plus 2 equals 5 syndrome, with the whole being greater than the sum of the parts. We should note that these synergy benefits accrue to the shareholders of the target as well as to those of the bidder. Merger can take place only where target shareholders are prepared to sell their shares. They will do this only where they are offered something in excess of what they perceive to be the current value, usually the stock exchange quotation of those shares, unless the capital market and the management of the bidder are basing their valuation on different information from one another. This can only exist due to the synergy benefits perceived by the bidder's management. So this refers to the concept, uh, the combined value of or performance of two companies after a merger or acquisition can be greater than the sum of their individual values or performance. In the other words, the merged entity can achieve synergistic benefits that go beyond what each company could have achieved independently.
Mergers, the practicalities. Financing mergers. It is important to realize that mergers are basically open market transactions, with one party, the bidder, buying assets from the others or the target shareholders. How much the bidders offer and its proposes to pay are matters of judgment, which must be decided by the management. Often in practice, such decisions are made only after taking advice from experts, usually merchant bankers. As regards financing, the bidders must seek a method that is both attractive to the target shareholders and acceptable to itself. In summary, the mergers involve open market transaction which that acquiring companies purchases assets from the target company shareholders. Decisions regarding offer price and payment structures are made by the management based on the judgment and may involve seeking advice from experts. The financing method chosen should be appealing to the target company's shareholders and suitable for the acquiring company's own financial requirements. The following are commonly encountered approaches to merger financing. Cash. Cash has its attractions to the recipients as it gives something that they can use immediately, either for consumption or investment, without having to incur any cost. Target shareholders receiving shares or loan notes that they do not wish to keep must incur cost and effort to them into cash. The receipt of cash will, however, in most cases be treated as a disposal for capital gains, tax purposes, and many shareholders will not welcome the possibility of a charge arising from this. In summary, the cash is attractive to recipients because it provides immediate usability without any conversion cost or efforts. However, Receiving non cash alternatives may involve additional steps and expenses. Additionally, the receipt of cash may trigger capital gains tax, which shareholders might not appreciate due to the potential tax liability it entails. Now let's go to the ordinary share in the bidder's business. Ordinary share may be attractive to the recipients, who would simply cease being shareholders in the target and become shareholders in the bidders. Before the merger, they hold shares in one business or the target, so are obviously not hostile to equity investment. Per This is not to say that they wish to hold shares in the bidder, in which case the problems of disposal mentioned above will come into play. From the bidder's viewpoint, issuing share to exchange for those of the target has its attractions. Cash will not lead to be raised, and a business will not be taking on the contractual commitments to pay interest or to repay capital, as will be the case with loan notes issues. In summary, offering ordinary shares as payment option in an acquisition bid allows the target shareholders to become shareholders in the bidder's company. While they may be attractive to some recipients, others may need to deal with the challenges of disposing of the shares if they are not interested in holding them. For the bidders, using share instead of cash can have financial advantages, such as avoiding the needs to raise additional funds or take on contractual commitments. Now, for the loan notes of the bidder's business. Loan notes have their part to play, but may have serious disadvantage from both point views, depending on the circumstances. As we have seen, loan notes create binding contractual obligation on the bidders as regard both interest and capital repayment. To the equity holder of the target, they represent a distinct change of investment, a change to risk return profile that they may find unacceptable. Switching back to the equities will involve them in inconvenience and cost, possibly including a capital gains tax liability. The advantage of loans notes in the merger's contact with would seem to be twofold. To the bidder, they will not have the effect of diluting control as a result of extending its shares ownership. To the recipient, they have the attraction that as well they have the fixed interest payment and usually have a fixed capital repayment date. Their market value is supported. Target shareholders who are skeptical about the future success of the merged business may prefer an investment in it whose returns are more certain than those from the equity capital. Appraisal of the merger by the bidder. A merger is simply an investment and should be priced as one. The expected cash flow from the merged business must be estimated and discounted according to a cost of capital factors that incorporates consideration of market perception of the risk of the merged business, that is the systematic risk. The cash flow that must be assessed will include all the normal operating cash flow of the new undertaking. In addition, any cash flow arising from disposing of any unwanted deviations of the target or the bidders arising from the merger, including any cost of making employees redundant, must be taken into account. We must also include the amount paid to acquire the target equity, where payment is not all in cash. The amount should include the opportunity cost of the equity and or loan notes issues. That is, it include the net amount of cash that would have been received from the share. Loan note issue had it been made for cash, assuming that all factors would have been the same. In summary, when appraising a merger, it is crucial to treat it as an investment. This involves estimating and discounting the expected cash flow of the merged business, considering market perception of its risk. The assessment should include all normal operating cash flows, as well as any cash flows arising from the divestitures and the amount paid for the target company equity. Factoring it the opportunity cost of non-cost payment. Now let's go to by the target shareholders. Appraisal of the offer by the target shareholder is just as much a capital investment decision as it is for the bidder. Each shareholder must assess whether further cash benefits from accepting the offer, suitably discounted, will exceed the discounted cash flow benefits of retaining the share of the target. What level of expertise and sophistication will be applied to this appraisal, and wherever it be done at all, on the basis suggested above, depends on the individual shareholders. The large investing institution will, it is presumed, reach their decisions on the basis of detailed analysis. This may be less the case with the individual private investors. In summary, the appraisal of the offer by the target shareholders is considered a capital investment decision. The level of expertise and sophistication applied to this appraisal can vary among shareholders, with the large institution presumed to conduct detailed analysis, while individual private investor may rely on less comprehensive assessment. The extent of the appraisal depends on the capabilities and resources of each shareholders. Divestment. There are three reasons for divestment. First is a desire to concentrate on the core activities. A business operating in a range of areas of activity, either as a result of organic growth or following mergers, may decide that it would prefer to concentrate on its main area of expertise. Such rationalizations have become quite common recently and possibly reflect a view, which we shall discuss in Chapter 16, that the future lies with smaller, more focused business. Now to the second reason, a wish to rid of some part of business that is causing problems. One typical problem will be a lack of profitability. This reason, together with the desire of concentrate on core activities, perhaps provides an example of opportunity of synergy, that is a 5 plus 1 equals 4 syndrome, where the sum of the parts. Now to the last reasons, a need to raise cash. The need to raise cash may arise from a desire to make investment in other parts of the business, perhaps including a merger. The reason given for many recent sell-offs has been the desire to raise cash to enable a reduction in the level of capital gearing. And that's all for our report about corporate restructuring.